Hi, in this podcast on Craft Beer Finance, we want to expand and show you an application for net present value to kind of give you an idea of what we're building on. Last podcast, we talked about discount rates, the rate, trying to estimate the rate of returns, or minimum annual rate of return that a investor or a party would want, either through a loan or an investment they make in you as far as a business. So we want to show an application of where this comes in handy. Um, One of the biggest areas where net present value is extremely helpful is helping companies decide what projects to invest in. If you recall back to this table, it was the examples we used in the payback podcast. The example: 6 different projects. Each of them we spend $20,000 at the beginning. Then we have different cash inflows for the years 1 through 4. When we use payback, one of the weaknesses we had there, well, what exactly is a good payback? Is it, 1 year, 3 years, whatever, and all the different other weaknesses associated with it. With net present value, we'll be able to apply a more objective benchmark to help us decide, at least on a financial standpoint, which of these projects we should invest. Literally, what we're going to do is take all of those future years, for instance, Project C, we'll use the net present value discount rate. In this case, we'll probably use 15%, and we'll take the cash flow earned at year 1 and discount that back to the present. And same thing with year 2, apply that a present value factor to bring that to the present, and so on, so that we can then apply that net present value rule. Remember, any project that has a positive net present value, we should financially accept. Anything that's negative, we should reject. And so now we can do this with all 6 projects to help us give us a way to decide which ones to take on. For instance, if we looked at Project B, this is laying out its cash flows. We spend $20,000 at the beginning, get $8,000 back at year 1, year 2, 3, and 4. Now, of course, the issue is somehow we've got to figure out, well, as we said with the time value of money, a dollar that's received in year 4 isn't worth the same as a dollar that we receive at year 0 or today. So one of the ways we can change, we can convert those future dollars to present is to apply a present value factor. There are tables that provide you the different present value factors where you have to look up the year and the interest rate that you use. But for the most part, for instance, in year 1, what we're taking is 1 plus the interest rate, or let me step back. We're taking 1 over the number 1 divided by 1 plus the interest rate to the first power, where the first power is n, which equals the year. So we'll take 1 divided by 1 plus 15th to the first. That converts to 0.870. And what that's doing is it's taking the $8,000 that we assume we receive at the end of year 1, and we're discounting it back using that factor by multiplying one times the other to say, here's what that $8,000 is worth today if we use 15% to discount it. And you can see in this example, the table calculates the present value of year 1's $8,000 as $6,960. Another way to think about it is if we had $6,960 today, we invested it at time equals 0, and it earned 15% for the whole year, it would be worth $8,000, including the interest and the principal. We do the same thing for years 2, 3, and 4. The only thing that changes, for instance, in year 2, is instead of taking 1 over 1 plus 0.15 to the first, we do 1 plus 1 divided by 1 plus 0.15 to the second power, and so on for each year. And then we calculate, we discount those cash flows to the present. Once we have all the present values calculated for each year, then add them together, and you can see that we get a positive $2,848. So according to our decision rule, we would say, let's accept this project because it's greater than 0 on a net present value basis. Then what we would do is we would do that for each of the projects, calculate all 6 net present values, and we would accept any that are positive. I believe, I don't have the results at hand, but I believe the only project that would have a negative net present value might be project A. That would be the only one we'd reject. Now, where does this come in handy? Well, it comes in handy a lot of times with what we call capital budgeting decisions, meaning things like buying big pieces of equipment, making major strategic decisions that'll go out over many years. And also it comes in really handy in valuing a company using free cash flow or some variance of it. What we have to do first when we want to value a company using net present value is we have to project or forecast our financial statements. The first thing we do is we have to develop a process for forecasting those statements and decide how many years we're going to go out and what discount rate we're going to use and so on and so forth. The most important thing when we forecast financial statements and trying to find the valuation or net present value is first we have to estimate the annual sales for the company. Once we've done that, then we can estimate the gross margins, the operating expenses, all other expenses associated with it, and project out the income statement for each one of the years we want to go out. Typically, we're going to go out 3 to 5 years, maybe 7 at the most. Then we'll have to do some kind of projection of a balance sheet, try to project out the receivables, the inventory, the cash, all the liabilities, and anything else associated with it, so that then we can develop a statement of cash flow. If you can remember from one of the early podcasts where we tried to estimate net operating cash flows, that's what we're doing here. Instead of figuring out the historical number, we're trying to project into the future. Typically, free cash flow is going to be forecasted where we have to estimate EBIT times 1 minus the tax rate, add back any depreciation or amortization expenses, non-cash expenses, subtract the increase in net working capital, and then also subtract out any capital expenditures, typically before worrying about paying off any debt or selling any equity or things like that. And down below you can see what the calculation is for tax rate and net working capital. So for instance, if we had a company that in 2012 had sales of $375,000 and the associated expenses and earnings before tax with net earnings of $20,000, and we had a historical balance sheet of these numbers, including $1.9 million for receivables and $1.2 million for inventory, along with the associated goodwill and property, plant, and equipment. Similar to the receivables, similar to the asset side, we also can have the historical liabilities, debt, and equity portion. We then have the historical numbers from which we can then do a projection. So for instance, let's say that company, we think that sales are going to grow 10% in year 1, which will be 10% times last year's sales, and it will increase, year 2 will be 5% times year 1 sales, and we expect it to grow 2% in year 3. We then can forecast out using different assumptions. We can forecast the various components of free cash flow to then bring it back to calculate a free cash flow for each year, and then use a discount rate by which we can then calculate a net present value. So in this company, we set some sales increases based off the historical numbers. We're going to assume that our expenses, assets, and so on are going to maintain the same relationships ratio-wise or percentage-wise of sales. We're going to then assume, instead of projecting out beyond year 3, we're going to sell the company at the end of year 3 for 10 times whatever its free cash flow is. We'll then apply a discount rate of 15% by each annual cash flow, including what we sell it for. And then, using the projections, we'll be able to discount it back to come up with a net present value. So here would be one example, just kind of a blank table that we would use. Plug in the revenues, send them forward, estimate the earnings before interest and taxes, after taxes, and so on and so forth. Get down to the free cash flow. Once we have the free cash flow number, we can plug that number in for years 1, 2, and 3, and then what we think the sales price would be, which would simply be 10 times whatever free cash flow was in year 3. Take each of those free cash flow numbers, multiply them by the present value factor, so we can convert the future cash flows into present values, add them together, and come up with an estimate of our discount rate, or an estimate of a net present value at a discount rate of 15%, which gives us a rough estimate of what we think the value is. That's one of the more complex but still very useful applications of net present value and discounted cash flow.